Welcome to The Explainer. Today, we're building the ultimate guide for new entrepreneurs, focusing on the very heartbeat of commerce, the financial engine of business growth. We are going to look exactly at how businesses secure the capital they need to succeed, and how they navigate that massive make-or-break choice between taking out a bank loan and giving up investor equity. If you've ever wondered how an idea actually transforms into a thriving enterprise, you're in the right place. Let's get right into it.
Think about this for a second. What do a tiny local coffee shop down the street and a fast-moving tech startup have in common? I mean, on the surface, their operations, their products, their daily routines, they look completely different. But beneath all of that, at some point early in their journey, they both face the exact same fundamental problem.
Yep, they needed money to grow. It's literally the universal requirement for turning any business idea into a reality. You could have the absolute best concept in the world, but without capital, that concept is going to stay firmly stuck on the drawing board. But where exactly does that money come from, and how do founders choose the right path?
Let's start with Section 1, Ahmed's $50,000 problem. To really unpack this, let's look at a hypothetical entrepreneur named Ahmed. He's got this brilliant idea for an eco-friendly packaging business. Now, Ahmed is incredibly rich in preparation. He already has interested customers lined up, a super solid business plan, and honestly just a massive amount of motivation. He's got absolutely everything he needs, except for one single critical element.
He needs exactly $50,000. He needs that specific amount of cash to buy the machines and the raw materials to actually manufacture his packaging. Like so many passionate founders out there, he's totally rich in ideas, but fundamentally short on cash. This is exactly where business financing enters the picture.
Which brings us to option 1. Self-financing.
Basically, self-financing means Ahmed dips into his own personal savings to get things off the ground. The massive upside here? Complete independence. Using his own money means zero debt, no investors, and absolutely no one telling him how to run his eco-friendly packaging company. He's got total control. But there is a catch. Relying entirely on his own pocketbook might not be enough to support rapid growth. It can severely slow a business down in those crucial early days.
So let's look at option 2. The bank loan.
If Ahmed wants to move fast, he can seek outside help from a bank. The mechanics are pretty straightforward here. The bank provides the $50,000 in capital up front, which gives Ahmed the immediate ability to buy his machines and launch quickly. It is a fantastic tool for speed, but instantly, the business assumes responsibility for regular payments and interest. You get the speed, sure, but you take on the financial burden.
And I really want to emphasize the major catch of a loan. Those regular payments and interest, they are due every single month, even if sales are slow. The bank expects its money, regardless of how well Ahmed's packaging is actually selling out in the market. That creates a ticking clock and a ton of pressure for a new entrepreneur.
So what if he doesn't want that ticking clock? Enter option 3, investor equity. Because the relentless pressure of a monthly loan payment is super risky for a brand new business, Ahmed might explore equity financing. This essentially means trading ownership for capital. Let's say an investor hears his pitch, loves the idea, and hands over the full $50K. The catch here is entirely different from the bank. That investor doesn't want regular monthly payments. Instead, they want a permanent share of the company itself.
You can really see what happens to Ahmed's slice of the pie here. Sure, he completely escapes the crushing pressure of a monthly bank loan payment, but his ownership has shrunk. He literally owns less of his own business than he did before. He's traded a permanent piece of his future success for the capital he needs today.
Which brings us to the core of our guide in Section 5, making the big decision.
This right here is the ultimate dilemma for pretty much every growing business. It's a stark contrast. On one side, the bank loan. You get to retain all your ownership, but you're chained to monthly payments and interest, rain or shine. On the other side, investor equity. You trade away a permanent piece of your ownership, but you get to walk away from those stressful monthly payments.
So what's the right move? Honestly, there is no universal right answer. A business with highly stable, predictable income might do great with a loan. Conversely, a fast-growing startup with unpredictable early sales might heavily prefer bringing on investors. Ultimately, the best path depends entirely on the specific profile of the business, its overall goals, the founder's risk tolerance, and what those future plans actually look like.
Let's wrap this up with Section 6, Why Financing Matters.
Zooming out from Ahmed for a second, why is this decision so absolutely crucial? Because without financing, businesses just stagnate. They literally struggle to grow in any meaningful way. They can't hire the top-tier employees they need, they can't buy crucial equipment, and they definitely can't expand into new markets. A lack of capital stops growth dead in its tracks, preventing ideas from ever becoming products.
I love this quote because it hits the nail right on the head. Financing acts like fuel in a vehicle. The business is the engine. You could design the most perfect, efficient, innovative business engine in the entire world, but without that financial fuel to drive it, that beautiful engine won't travel a single inch. Understanding this is essential for anyone who wants to know how modern businesses actually succeed. So put yourself in Ahmed's shoes for a minute. Knowing the trade-offs, the risks, and the rewards, to fuel your own success story, would you rather owe money every single month or give up a piece of your dream? It's the toughest question in business, but now you have the guide to help you answer it. Thanks so much for joining me on this explainer, and I'll catch you next time.